Time for Ask Annex, joined by Matt Morzy, Investment Team Manager, CFP. Welcome.
Hey.
Fred Coleman, CFP and a Wealth Manager. Welcome to you.
Hey, Danny.
Question 1 on Ask Annex. I'm recently divorced and my ex-spouse was always the breadwinner in our household. I'm planning to take half of his Social Security. My FRA is 67. I'd like to know if I start collecting spousal Social Security benefits at 67 and also collect a government pension, would my Social Security benefits be affected by receiving a government pension?
Great question. It's a lot of moving parts here. So I'll start with the rules when it comes to get your ex-spouse's Social Security. So after a divorce, in order to collect your ex-spouse's Social Security, you must have been married for 10 years and you can't remarry. Also, you'll either get half of what your spouse's benefit is or you'll get your full benefit. So if your benefit is less than half of your spouse's benefit, then you'll get your ex-spouse's benefit. Because you're collecting a government pension, there's also a thing called GPO. So that's government pension offset. What that means is you take your pension amount and 2/3 of that has to be subtracted from whatever half of his Social Security is. So it could be reduced all the way to zero. So I recommend speaking with a wealth manager and then also a divorce specialist. We have CDFAs on our staff that can help you navigate this with a great plan.
That is really complicated.
Absolutely.
Yeah, right. Is that on the CFP exam?
It's on there. It's on there for sure.
Wow. Okay. Question 2 on Ask Annex. Is it meaningful to compare EPS across companies? That's EPS is earnings per share.
That's correct.
Okay. Is it meaningful to compare EPS across companies? It seems like an unfair comparison because, all things being equal, a company with a smaller number of shares outstanding will report a greater EPS than a company with more shares outstanding.
Yeah, assuming they have the same amount of earnings, which, two companies are generally not going to. So earnings per share is something to compare against a company's own history and where they're going in the future. If earnings per share is growing for a specific company over time, that's going to be a good sign. As the question points out, though, if they are buying back shares and their share count is reducing, even if their earnings stay the same, their earnings per share will go higher. What I think is a really useful exercise, if you're going to try to compare companies against each other, is looking at price multiple off of that. So like price over earnings. So that way you're taking that earnings per share as the bottom part of that and you can equalize that against other companies. So regardless of how many shares they have, you can compare two companies and what their PE ratio is against each other. Now, again, you're going to want to compare how that company is against itself in the past and where you think it's going forward. And are they in the same industry? Are they in the same subsector of that industry as well, too, that they could be comparable against each other? But looking at historical ranges is going to be really important. Looking at trends over time is going to be really important. So there's a lot to put into that. Especially the market is going to have an impact on what that price is for that share. And it's going to tell you something on if a company has a higher PE, it's going to be more expensive. But there might be reasons why it's more expensive and the company's rewarding the growth of that company and rewarding what that future prospects look like. So a lot to dig in there. But yeah, EPS by itself, it's hard to compare.
So it's earnings season, right?
Yeah.
Is that one of the numbers you'll look at first?
Certainly up there. When we're looking at one company, again, specific to itself, you're going to want to be looking at what have they done historically. But again, these comparisons are all made to what do you think is going to happen with the company, because you're not buying what the company did before. You're buying what you believe the company is going to do going forward. So you want to see how is that company, projecting out their earnings growth over time and what are the different catalysts that will help get them there. And do you believe that those catalysts will come true, or do you have a different idea of what's happening?
It's Ask Annex. Got a question for us? You're always welcome. Head to the website, annexwealth.com. Don't have to be a client for that, by the way. We get back to everybody. Some of them wind up on the radio. Question 3, Ask Annex. Why is the 60-40 portfolio back in fashion? And Fred, just a quick explanation on what 60-40 is.
Sure. So 60% stocks, 40% bonds. It's usually looked at as the basic moderate portfolio. Depending on your risk tolerance, it can go either way. But looking forward, 2022 was a really painful year, right? And 2023 got better. But the main reason for that was because of the quick rise in interest rates. Historically, the 60-40 portfolio has done very well. And looking forward, for the first time in a long time, you're going to be able to get some type of yield off of your bond portfolio. For the longest time, interest rates were very low. Now you can, get 4 or 5% of yield, which is really going to cushion the returns of that portfolio.
Yeah, it's important to remember that these things are going to go in trends. There's going to be time periods where certain allocations or certain type of investments are going to be in favor, and other times where maybe they're going to underperform or maybe they have previously underperformed, but people want to, throw them out. 60/40 does tend to be kind of that modern investor's allocation over time. It is considered to be, the most popular one that people talk about. It's not necessarily right for everybody. If somebody's going to be aggressive, they're certainly going to have a lot more equities in it. If they're conservative, they're going to want to have less, but they do need to make sure that there's that balance between the two. And stocks and bonds really are the two main building blocks of most portfolios. So that's why they get compared together. And you're right, Fred, having yields back available within a portfolio getting 4 or 5+% is really, really attractive and does provide some investment return on the fixed income side of things. And the chance that at some point the Fed will cut and you'll get some capital appreciation on that as well too, as bond prices go up when rates go down. So that's going to play off of each other. But it's something to watch over time and make sure that that's comfortable for your own risk tolerance. Not everybody's going to be a 60/40, but a lot are. But again, where you are and you're, from an age perspective, can you sleep at night when the stock market goes down? Are you going to worry about things? There's going to be areas of that you're going to want to make your own changes to. But when we think about is the 60/40 dead or is it back, that's really relative to where you are at that point in time.
Let's ask Annex. Matt Morzy, Investment Team Manager, CFP. Thanks.
Thank you.
Fred Coleman, CFP and Wealth Manager. Thank you.
Thanks, Danny.